Welcome back. In this lesson, we're going to look at trend and structure. We're going to do this on the 30-minute time frame. Now, at the end of this video, you should be able to establish directional bias before actually looking for a trade. Now, here's how to read it. All right, so let's jump into the charts to see how we're able to count the breaks of structure on the 30-minute. So I mentioned that look 2 days or 3 days previously to see what the trend looks like and see where the breaks are. So let's go back a couple of days. Let's see how we can identify breaks of structure. Okay, so let's say we start from this day. Okay, we look back, let's say we are here, let's say there's nothing, we don't have any insight as to what is happening here. All right, we look back 2 days, what do we see? On the 30 minutes, we can see that we're breaking structure. We have multiple breaks of structure to the downside, multiple breaks of structure. The next day, we also still have multiple breaks to the structure. Okay, so coming into this particular day, I'm anticipating that we might just take liquidity at some highs. It will come to liquidity. Once liquidity is taken, I expect us to continue moving down. Okay, so that's an example right there. You just look, and sometimes when you get very good at this, you can just quickly glance. You don't need to count how many breaks. You can just look and you definitely see that there are multiple breaks in one direction. Okay, so when we talk about the concept of liquidity, you would understand that it's not just about lower lows and lower highs, lower lows and lower highs, lower lows and lower highs, lower lows and lower highs. There is the concept of liquidity, and that's how a lot of people get trapped with just simply understanding market structure and not understanding liquidity. So you'd ask yourself, why the hell would price come up here to sweep this level before turning back around? And that is the concept of liquidity right here. Okay, so let's say we are on this particular day. Let me use a difficult example. We're on this particular day right here with this red line, and you start to see, okay, this is what you're seeing, this day, this day, this day. Here, we're pretty much moving sideways, so you can ignore this. But the next day, you can tell that we're breaking structure to the upside, okay? Breaking structure to the upside. So we're looking at bullish price action. Now, if you come into the day, okay, and yes, you're seeing bearish price action, and price is not reacting from levels like fair value gaps, order blocks, it's not reacting from levels that it should, then there is another model called the bias flip, which allows you to change your bias when you detect that price is not respecting gaps or respecting areas where you are expecting to see price turn around. Now, what separates a beginner trader from a pro trader is what he does when he notices that his levels are not holding. Okay, all right, so let's look at one last example and then we can jump off. So we have here, this day we had some form of consolidation. Let's say you're on this day, okay, you have no idea what's going to happen on this day. Let me put a red line there. Okay, so all you have is this data. So you look back 2 to 3 days, what do we see? Pretty much consolidating, but I do see that getting to the end of the day, we are breaking structure to the downside. So you can see here, right, with this red line, you can tell that we are breaking structure to the downside. Again, we continue breaking structure to the downside. All right, you can tell, okay, here again, we're breaking structure to the downside. So as you can see with the red lines, it's very evident that price is moving in one direction. Okay, you can see that it's stepping down. Okay, stepping down, stepping down, stepping down. So when the session opens, you're expecting price to do what? To step down. Now, in order for you to do that, you need to anticipate, or you need to understand the concept of liquidity, which I'm going to teach you in a couple of videos. So now if you look here, so I'm going to mark this liquidity level in green. Now this is the last high that broke this low. So I anticipate that price will come back here before continuing to move down. And that's the concept of liquidity. I'll expand it in the next couple of videos. So now when you have fair value gaps that are aligning with liquidity, it makes it even high. It makes it a high probable setup. Okay, so we've come up, we swept this liquidity, we've tapped into this gap, and what do you see? Boom, boom, boom. Price continues ripping lower. Okay, let's come into this particular day. Let's say you've been able to execute this day. You come into the next day, what do you see? Price is still breaking lows. Okay, price is still breaking lows. You can put more lines there to determine what's happening. You can tell that price is still breaking lows. So coming into the session, you could be bearish. And the entry models do exist. Liquidity levels are very specific. We do have a fair value gap here, right? So if the market opens, you'll be looking at what price does, because we're anticipating price to continue moving down. Okay, so when the market opens, you're expecting price to pull back to either sweep liquidity above this area, okay, sweep liquidity above this area, or tap into some PDRE like a fair value gap, an order block, or whatnot. So there are specific levels that you need to take note of that price can tap into and then continue, or price could totally disrespect, and you then have to know what you'll be doing next after that. All right, so in this case, the market opens up, taps into a fair value gap right here, and then what does it do? It continues to melt. Okay, all right, so now getting to the end of the day, price price continues to rip lower up until the end of the day. Now we're still bearish. Why? Because this is the last high that led to this low, and we expect that price doesn't go in one direction like this. There are pullbacks. So what do we see? Yes, a start of a new pullback. This is not convincing enough to tell me that price is ready to go back to the upside. I'm expecting price to pull back to a certain level and continue the trend. Okay, so sometimes you can use the Fibonacci to see how far price has retraced. For me, I do prefer price to retrace at least 50% into some fair value gap or some order block or some area of significance. In this case, as you can see, we did retrace more than 50%. And what did we do? We tapped into some significant fair value gap, which is this first fair value gap after this pullback right here. Okay, so this is an order block, this is a fair value gap, this area is significant. Now what happens? Price tapped into this area and began to show us bearish structure. Okay, there are entry models that I'm going to show you on the lower time frames that could probably have given you an entry somewhere in this area. All right, so that's about structure. I want you to go to your chart. I want you to be able to look 2 days prior, 3 days prior, look at where the breaks are on the higher time frame, specifically on the 30 minutes. Look at where the breaks are, and based on the breaks, you would be able to identify your bias for the day. Let's look at one last example. So here, imagine we don't have an idea of what is happening here. Okay, look at the previous 2 days. What do we see? Breaks of structure to the upside, breaks of structure to the upside. The next day, what do we see? More breaks of structure to the upside, more breaks of structure to the upside. So I'm coming into this day with that same bias. Okay, I want us to take liquidity at some point before continuing. So I do see a break above, a pullback, a break above. Now the market opened somewhere around here, right around here. So what do we see? A pullback into what? A pullback into a fair value gap and a rejection. Okay, on the lower time frames, you might be able to catch something right here to take price to the upside. Okay, so it's as simple as that. Market structure and liquidity should be your best friend. So that's about it for structure. I want you guys to go look at your charts, go see if you can identify structure at least consistently for about 2 to 3 days, so that it can kind of prep your minds to spotting where the market wants to go based on the breaks of structure in a specific direction. I will catch you guys in the next video. Make sure you like this video, make sure you subscribe, and I'll see you in the next one.